and welcome to CNBC-TV18. You're watching Market Sell-Off. I'm Ekta Batra and with me is Prashant Nair. Here are the top stories that we're tracking this evening. Stock markets remain jittery across the world after Silicon Valley Bank becomes only the second in US history to go down. US government steps in to avoid contagion and shore up confidence. HSBC agrees to buy the UK business of the bank. Dalal Street hits the lowest level in 5 months after a sharp sell-off. 46 out of 50 Nifty stocks end in the red. All sectoral indices decline in trade. Bank stocks get pounded across the world as fears of a contagion loom large. The Nifty bank tumbles as all banks that constitute the index end in the red. All right, well, it was definitely a weak day for the markets. We had the Bank Nifty, which ended 920 points lower. We had the Nifty, which lost around 258 odd points. Now, for a quick closer look at the market action, stock markets are on tenterhooks across the world after the collapse of Silicon Valley Bank and fears of a contagion. The US government has stepped in to quell some fears, but that did not stop a rout across global markets. The Sensex and the Nifty have hit their lowest levels that we've seen in 5 months, thanks to the weak global markets. We have bank stocks which were at their worst. Well, Prashant, today was a rough day. It didn't start off that rough. It became rough more when we had the news about HSBC really bailing out SVB's UK arm. That's when things got a little rough for us.
You know, so there were two things, right? SVB we all know about, but I think what has happened is SVB collapsed. It went into receivership on Friday. This morning, the Fed said they're going to protect all depositors, all deposits. But that has led to a run on another bank, Signature Bank, right? And the Fed has stepped in to sort of solve that situation as well, saying that both banks we are taking care of. But the fear is that perhaps it's not just two, there are more. And I think that is what is feeding the worry at the margin. So the Nifty ending below the Feb lows, 17,255 was the low. Bank Nifty ending about 40 points above the Feb low. I mean, so for all practical purposes, those levels in a way are gone. All sectoral indices in the red. Banks, of course, here worsted as well, although you can wonder and genuinely ask what is the relation. But banks here were take a hit as well. Now, failure of SVB Bank, as I said, Silicon Valley Bank, led to a run on another bank, which is Signature Bank. And Fed has stepped in. It said that they're going to protect depositors in both situations. And as I said, the fear is that perhaps this is not the end. We got, while we were sort of presenting closing bell, the last hour show, reports came in that there was another bank which in pre-open was down 60%. European banking stocks were under pressure in a significant way. The dollar index, which had sort of collapsed in the morning, that had come up a little bit. As consequently, the dollar rupee, the rupee actually ended pretty much at the low point of the day after starting in a very smart way higher. So, you know, it's just kind of fear. The market is sniffing for weaknesses in a almost in a very systematic kind of a way. And I think one can only hope at this stage, at this point, that there is not that much trouble to be found. And if there is trouble to be found, things perhaps are contained. The last thing we need is a banking sort of contagion because, you know, those things are pretty bad, as we all know from 2007, 2008. I started this morning by saying that Silicon Valley Bank and what's happening, and people were throwing around the word that this is, you know, this is the Lehman moment for our era, this era, etc. I started the show this morning by saying, well, let's just completely be clear that this is not 2008, but you know, and I still say that this is not Lehman or Bear Stearns or any of that. But sometimes, you know, things, especially on the banking side, which is very much built on trust, become self-fulfilling prophecies. But I just hope that this is contained. The government in the US, of course, has stepped in, and we perhaps will see more action over the next 24 hours, 48 hours or so. Ekta, we have Samir Arora joining in. He's founder and fund manager at Helios Capital, someone, of course, who's seen it all, I dare say. Samir, great to have you with us here. Thanks very much. What's happening? What's the big worry? Is this going to get bigger than what we know at this point in time?
I don't know. But first thing is that maybe it becomes a little bigger in the US, but the Indian banking system is very different. And in the US also, in some sense, you can say that the Federal Reserve has come in quite promptly over a weekend, saving at least the depositors, which is the main thing in terms of contagion. So maybe there's another one bank here or there, but I would not think that beyond a point. Of course, it'll matter to Indian banking sector just because if one sector does badly, somewhere there is some pressure. But broadly, I don't think any of that will be felt here beyond just the stock market impact for a few days.
So, I mean, European banks are selling off. Commerce Bank and the largest Spanish bank is down 4-5%. In pre-market, there are other US banks which are down sharply.
US has a number of these small regional banks which are catering to some community, some narrow sector. I would think that the European, at least the big banks that we have heard about, they are not as narrowly funded. They don't have so much reliance on one class of deposit. If you look at, say, Silicon Valley Bank, and you say that the average deposit was X million dollars, not hundreds of $1,000s, but millions of dollars. And then you say that actually they were behind that being driven by a few VCs. So you might see 20 accounts, but at the back of it, one VC owner said that redeem or whatever, take out the deposits or transfer them. And therefore, effectively, the number of independent borrowers were very less. Second thing, at least when we compare it to India, maybe not to Europe, I don't know as much, but to India, is that we have such a large retail funding. And what will the Indian public do in terms of taking it out and buying bonds with it or something, because the interest rates are similar in that sense. And plus in India, the HTM is a valid concept for about 2/3 of the bonds being held to maturity, and these maturities are not 10 and 20 years, but broadly 2, 3, 4 years. So I don't see why it should transfer to India, except in this concept that if banks are doing badly somewhere, then they will do, everywhere, then they might do badly here in terms of stock price movement for a few days here or there.
Okay. Samir, do you think that what the market was anticipating from the Fed on the 21st, 22nd, when they meet later on in the month, of an aggressive rate hike, some were anticipating around 50 basis points, that will get tempered down? So we're probably working in a scenario.
I think right now Goldman Sachs is right in saying that there will be no hike at all. Because it would be funny for at one point to say we need to do ABC for the banking system and separately say that the issue that caused that the banking problem or whatever, that simultaneously I will on the other side raise rates. They will most probably say that we are keeping our current rate and we are still not backing off, and we might do it after 1 month when things stabilize. And in some sense, the market also has time to do whatever changes they want on the margin. But it would be too ridiculous to be bailing out some parts of the market which are caused by high interest rates in some sense. And then separately say we are still increasing it more for now.
So Samir, given this conundrum that we're in, or this uncertainty that we're in, how would you approach the markets at this point? Would you be a buyer in select stocks, select sectors?
Well, we are already bought as much as we wanted to, or our funds broadly allow, except in the long short fund, I can increase, but I'm not doing it like I didn't do anything today. But in general, I have, because I've done this for more than 25, 27 years, I have to just pat myself on the back that you can even go through these kind of things for 27 years of randomly things moving up and down. Now, of course, today is disheartening, but I think as we have seen all the time, that if you overdo anything on the negative side, then it reverts to the mean, and maybe also on the positive side. I would think today that in general, the Indian guys are overreacting, and maybe it's the foreigners who are overreacting, not the Indian guys, but the Indian market is overreacting for sure. Does not mean tomorrow morning you may buy or not buy. But broadly, I don't think this contagion has much to do with India, and it is not of the scale which we have seen in the past, where the contagion spreads to financial assets worldwide, independent of what is the underlying issue. I think India in general is benefiting or will benefit over time for broadly standing out. At least in financial sector, we are quite well regulated, and the capital is good, and generally the deposits are granular, and generally all the good things that you would associate with the banking sector. For now, India has that.
You said the thing that caused the problem, higher interest rates. I'm not. I know you don't fully agree with them. And the bank's behavior caused a lot of it.
No,
But
no, no.
yes,
In a sense, what I mean is,
I know.
It's their problem because when they bought these bonds, they may not have
Yes.
thought that the rates will be so high.
Yes.
So in
Yes.
that sense, there might be many banks with similar issues.
Yes. No, I'm just coming back to you, Samir. My colleague Lata actually presented this very disparate view amongst economists in terms of what the Fed will do. There is Goldman on one end and there is Citi on the other. Let's go across to Lata. What will all of this mean for Fed's sort of hiking program? Lata, over to you.
Thanks to the collapse of SVB and the jittery state of other banks like Signature, economists are beginning to pencil in fewer rate hikes from the Fed, but the street is deeply divided. Goldman Sachs is at the one extreme end, expecting no hike at all in the March 22nd meeting, but it is seeing one hike each in May, June and July, taking the terminal rate to 5.25 to 5.5. But Goldman Sachs is adding in its report there is considerable uncertainty about the path, about the future path. Now, Citi is at the other extreme. They spoke to CNBC-TV18 and the global economist Robert Sorkin said they continue to expect a 50 basis point rate hike on March 22nd and a terminal rate of 5.5 to 5.75 with risks to the upside. That is, even 6% is possible. Now, Sorkin told us he thinks SVB is an idiosyncratic case and that the US banking system is healthy, big banks have high capital. Also, on the economy side, payrolls data showed that the labor market is strong and the Fed wants to see it slow down. Labor market and inflation data will dominate the Fed's thinking, he said. Banking stability will be a marginal concern. That's Sorkin of Citi. Nomura analyst Sonal Verma continues to expect a strong CPI data that comes on Tuesday evening and hence a 50 basis rate hike like Citi from the FOMC on March 22nd. So Nomura maintains that 50 basis hike call, but they again add the same phrase, uncertainties have increased. Morgan Stanley's Ellen Zentner and others writing on Friday said that they are continuing to go with a 25 basis hike unless this week's, that is Tuesday's core CPI comes in higher than their estimate of 0.38%. And finally, what does the broad market expect? As per the CME FedWatch tool, currently 93.7% expect a 25 basis hike. That is up from only 59% who expected that on Friday. And guess what? 0% expect a 50 basis hike, down from 40% who are expecting 50 basis hike on Friday. By the way, I must mention a minor 6.3% expect no hike at all. So the confusion is complete.
Lata, thanks very much for that. The confusion is complete. Samir, on that, so the primary worry was how fast will Fed hike, and now you're saying, well, at least in the next meeting on the 22nd of March, there is no hike. They cannot possibly do 50, maybe 25, one doesn't know. Tomorrow we get CPI numbers out of the US, right? I mean, they're calling it the biggest decider now. And what happens if you get that very, very high, a very hot number?
Just before that, suppose ignore that for the now and let's say what Citi and Nomura are saying happens, which is a 50 basis point hike. I think it's super bullish for the banking sector because it would mean that the Federal Reserve thinks that this problem was truly idiosyncratic and truly isolated. And from now to whatever date this interest rate hike has to come, they would have studied even more that the banking sector is going to be able to handle in a very short period. Because obviously, whatever they might say about inflation, they would not want that 3 days after the interest rate hike, some bank blows up, which is more directly than associated with this last hike, saying that prior to that it was okay and this last thing sort of pushed it beyond limit. So I would think in general, the easiest thing for anybody to do, and my assumption always has been to take the path of least resistance, is actually maybe if tomorrow's number is high to say a quarter point rise and not to add to the stress, but say that the terminal rate is not changed. and that, it's just a matter of going through this period and we will take the data and all that. But not to add to it, if their view, so what I mean is it will be positive actually if it's a 0.5% hike, because it would be like a clean bill of health for the banking sector there.
Okay.
Or an ability
Samir,
to handle that hike.
Okay, Samir, 2023 started off on a rough note, you'd have to say, for the Indian markets. We had the whole Adani issue to deal with. Higher interest rates is looming around us in any case, and now this whole banking issue. The market is, Nifty's corrected already, already corrected 4 to 5% on a year-to-date basis. Do you think there's more to go?
No, I think that shows incredible strength of the market. Because if you randomly ask me how much can the market fall next month without you being able to even connect it to an event, history would show that that these market can fall 5-7% without you exactly knowing why it fell. So in that sense, to be able to absorb the Adani issue, to be able to absorb the massive flight of money that happened in the first month to play this wrong trade of money going to China from India for opening up, which fell flat in the end. And then India losing only 4-5% is not that bad. I am still bullish on India unless you say some new crisis happening. This banking sector in the world is a bigger issue than one bank here or there. And that also bank there, in some sense, you can see that there was a technical issue of, very high concentration of deposits and being driven by a common set of end investors and all that kind of stuff. Then it would be different. But otherwise, 4-5% is, for all these events is not the end of the world.
No, absolutely. Samir, stay with us. Just coming back after a quick commercial break, we'll continue our conversation. Stay with us. Okay, welcome back. Samir Arora, of course, is still with us, and we've been talking about the events of the last, 48, 72 hours or so. Samir, so for viewers who are watching and who are looking at, what's unfolding, what is the advice? Everyone watching, I'm assuming, has some exposure. The question is, should they get more exposure? At what pace? And if you want to get exposure, should you be prepared for flat returns for some time? So don't go all in. Is that the way to look at things? Go on.
So I would think that what you do, as you said, depends on what you have done. So if you are reasonably exposed, you can slow it down. But if you are 10-20% in equity, beyond a point, that perfect timing will not matter. But I would think in a big picture sense that in the next few months, now maybe we can say end of year, that the US rates, people will start imagining or discounting that they will be reduced again. But in between, what has happened in the first 2-3 months is that the numbers that we were expecting for terminal rates in US to be, say, around 5.25%, then people started talking about 5.75 to 6%. But that implied that nothing else has changed. It implied that the job growth will be there and people will be, comforted. The individuals will be, but the Federal Reserve will say, now I have to hike rates. Now, if there are 1 or 2 bank failures, whatever may be the underlying cause, this itself will cause some slowdown, some X basis points lower spending, some conservativeness by the employees, by potential by other bank employees, by tech sector. So I would think that the 5.75 to 6 will be maybe on the lower side rather than the higher side. So therefore, it's a matter of 5-6 months, and the theory goes that the markets discount at least 6 months ahead of time. So you will not be able to precisely time that even if 6 months later this thing has to happen, that I will wait for 3.5 months and then buy. So the old formula works. Average in based on your comfort, based on your starting position. But broadly, whatever you do, not to walk away thinking that some great crisis is ahead. Because even if there is one, I think there is zero probability of a great crisis. Even then, in the end, it turns out that the markets do better than whatever else you may do in life in terms of investing.
Okay, well, Within the markets, though, Samir, I just had a quick question. Relatively better this year has been a couple of these IT stocks. TechM is up at 11.5%. HCL Tech is up 5.7% on a year-to-date basis. Do you think that this is probably the time to put in some money in IT stocks specifically just because they've been relatively resilient till now?
No, I don't believe so. I think they've been resilient a little bit because they did very badly last year. So maybe a little bit of that has happened. Right now, our belief is that it is better to be in more India-centric businesses rather than a global-facing or US-facing. Because whatever you may say, the US tech slowdown is for real, whether anybody says that now we will get this project or that project. And maybe that we can consider in April when these guys give guidance. If you look at what NASSCOM says, you look at anybody, everybody agrees there is a big slowdown. But the tech companies are able to cover it by saying, although there is a slowdown, we think we will get this or we will get that in terms of cost-related, cost-saving projects rather than discretionary projects. Our belief is that the guidance for the next year will be 6 to 8% in dollar terms, which according to us is nearly in line with the GDP and therefore not of much interest to us.
All right,
Samir,
Samir,
double-digit guidance will be a different thing.
Always a pleasure speaking with you, Samir. Thank you very much for joining us this afternoon. Thanks indeed for being with us here today. Well, with that, it's a wrap on this edition of Market Sell-Off. Thank you very much for watching. From all of us here, goodbye. More comes up on the other side.